our next guest says Europe's stress tests need to be a lot tougher if they are to reassure investors. Simon Ballard, senior credit strategist at RBC Capital Markets, joins me now. And Simon, I want to start actually by asking you about what European regulators have been saying. They're insisting that banks need to raise cash themselves before they get any kind of help from the state. Is that a good idea?
I guess, what they want to do is you see the banks to be sort of able to help themselves through the market. The question is, how transparent and how clear and, the level of clarity that we're going to get in these stress tests. And if we don't get the level of transparency and clarity, as we perhaps had, say, in 2009 with the US tests, then you're not going to see the recovery or the rally on the back of the news as they come out. But clearly they want the banks to be able to look after themselves if they can. But if you fail the test and you go to the market to try and raise funds, it's a question of, can you get the funds at the right level that really makes sense for you? And at the end of the day, is the backstop bid there, and is the backstop bid deep enough to, to cover all those banks that might fail? And if they don't fail, is it because the tests weren't strict enough? And perhaps we should hope for a few failures in order to make sure we get that level of clarity.
And what are we seeing right now in terms of Europe's banks looking to tap the bond markets? Many of them looking to try and raise some cash in the markets in the coming weeks before these stress test results are released. Well,
you've had two elements to that. You've had a big amount of issuance over the last couple of weeks on the back of improved sentiment that they are going to pass the test. That you are starting to see austerity measures coming to fruition in Greece and Spain, etc. At the same time, you're moving into the summer period, kids breaking up from school at the weekend, etc. So people wanting to get ahead of the slowdown for the summer. So I think we're going to slow down as from the end of this week after, say, the 14th of July and Bastille Day, traditionally a very quiet period. When the tests come out, it might be a lot more difficult to issue debt of any magnitude, and when we come back in September, it could be a very different scenario.
So the summer months things slow down, so there is already a race to raise as much as you can in the capital markets before that, and as you say, August and December are also pretty slow, so we're talking about a very limited window here.
You have a very small window of probably 2-3 months maximum when we come back in sort of early mid-September through until late November, early part of December. So they want to get out there and get it done early if they can.
I suppose Spain's bond auction last week would suggest that sentiment is turning around?
That again has been one of the positives. We've seen that. We've seen, the last couple of auctions from Spain have reputably been taken down very well. Greece theoretically has funding in place now for the next 2 years.
They're now issuing €1.25 billion worth of bonds.
They're doing the very short stuff. But the big question is, are they addressing the longer-term fiscal woes that they've got to address? Is this sort of putting off until tomorrow what really should be trying to address today? Yes, the deficit numbers in Greece are coming down, but I think the more austere we get over the longer term, the more weaker and the more challenging macro environment we lead ourselves into for the back part of this year and certainly for 2011.
And if we look at the banks, the likes of Barclays, BNP Paribas, HSBC and UBS have benefited from this improving investor sentiment that you talk about. But tell me a little bit about banks which aren't doing so well right now, which have struggled to raise the cash that they need in the markets.
I guess, the problem is it's the lack of transparency again. If you have transparency on the banks that do have exposure to Greece and the peripheral debts, then they're the ones that are able to come to the market.
But aren't the stress tests supposed to resolve this issue?
They are, but if you have faith in the stress test and the results of the stress test, then well and good. But there's still a lot of scepticism out there as to really whether we're getting the right answers in all of this.
So it sounds like a vicious circle.
It is for the time being.
How do you break out of it?
I guess, how do you break out of this? You position yourself very carefully. You do some very careful bottom-up analysis on the individual financial institutions that you want to invest in. And then hope for the best after that. But certainly it's going to be increasingly challenging going forward.
Simon Ballard, senior credit strategist at RBC Capital Markets, thank you so much for your analysis, your insight.